Singapore equities remain resilient in 2026 as steady retail inflows cushion STI swings despite institutional investors driving market direction. To put these market moves into perspective, we have Carlos Lim of CGS International Securities and Carmen Lee of OCBC. Welcome, Carmen and Carlos. So, for context, what exactly is keeping Singapore equities resilient in choppy markets?
Thanks for having me. I think we could break it down to a few matters. Fundamentally, Singapore names are of high quality. They are dividend-paying names like OCBC, UOB, those banks, and the REITs. Number two, I think also is because of the investor base that we have in Singapore. We have quite a large base of long-term holders. They'll just keep those markets in line. We also have bargain hunters and also high-frequency traders who actually will trade in and out. When the markets are choppy, they will come in and buy the bottom and sell the high, so keeping it a bit more stable. Not to forget, then the government has the EQDP program. Currently, there's about 15 billion invested into the market. The structurally that helps the market to be a bit more resilient.
What happens, of course, is the fact that one of the key factors driving the Singapore market has been what they call the EQDP program. That is the Equity Market Development Program, which the government came up with about 15, 16 months ago. And together with them, they have actually set up a fund. They've also ensured that the whole ecosystem is really ready for a much more vibrant market. So that involves quite a lot of parties, including asset managers, broking houses, research houses, investor relations. And so because of this whole excitement and fund coming to the market, that in a sense led to some of the what I call preemptive buying, which was also largely retail view. So as a result, we have actually seen that the Singapore market has done exceptionally well in the last couple of months as well.
Can you explain this in detail? How exactly are retail flows cushioning STI downside swings?
Yeah, I think it backs down to the fundamental of Singapore's names. Yeah, when the quality is there, I think investors know of quality. We operate within Singapore, Malaysia, Indonesia, and Thailand. Relatively, Singapore carries a lot more quality names, fundamentally strong names. Hence, investors know this. Investors have a lot more information now compared to the past. And we do see them coming in, being bargain hunters, evident by the past. So that keeps the market a bit more stable and then playing quite a big part in keeping the Singapore market vibrant and at a comfortable level.
Largely, this will be directed at some of the more what we call small mid-cap or SMID companies. So for longest time, the market has been very excited about some of the bigger cap, which will be the STI dirty stocks. But the smaller mid-cap stocks have actually, in a sense, been quite neglected for many years, which is why valuations for all the stocks have been quite low. But having said that, with this whole EQDP program now that the government has actually started, and of course 9 asset managers have already been appointed. Large part of this flow will go into some of the SMID stocks, and which is why ahead of this whole deployment of funds, I think some of the retail interest has already started to come into the market, and that has actually supported the Singapore market.
So for you, can retail investors set a stronger valuation floor in 2026?
Good question. I think the answer is we don't know. Although the retail flows base that's flowing into Singapore are larger by the year, but I yet to see them being the benchmark setting the valuation. Being in the market, the companies themselves have to be more transparent and communicate clearly whether the valuation deserves a higher one or they can stick to where they are. But fundamentally, going into 2026 second half, fundamentally the Singapore market looks good. It is a global market in nature. It has withstand the storm of what's happening till now quite well. To just continue.
The funds have actually partly been deployed, not fully been deployed. So if you've read the sale budget, you'll notice that actually that number has actually gone up from 5 billion to 6.5 billion. And that will be given to the asset managers. And there's, of course, a one-for-one matching from some of the funds as well. A large part of this should go to the small mid-cap sector. And as I said, some of the funds have not been deployed. So second half of 2026 could possibly see a large part of this fund coming to the market. And that should still continue to support the interest for the small mid-cap stocks.
Thank you so much for sharing your thoughts, Carlos and Carmen.
Thank you. Thank you for having me.
Once again, those were Carlos Lim, Group Head of Securities and Leveraged Products at CGS International Securities, and Carmen Lee, Head of Equity Research at OCBC. For more news, visit sbr.com.sg.